Howdy, Jacob here. Today we're looking at PNM Resources. $3.1 billion market cap on $6.9 billion enterprise value. A lot of net debt in the electrical utilities industry. No surprise there, matching up very well with the other ones. 4.4% dividend yield. Revenue growth looks to be probably in line with inflation, maybe a little bit more. Last 2 years have exploded. Return on invested capital, very, very poor. Both margins are down quite a bit. Gross margin down from 56% to 50%. Operating margin from 21% to 17%. Balance sheet, $4 million cash on hand, $417 million short-term debt, $3.9 billion long-term debt. They don't produce free cash flow. Extremely short video here. I'm just going to go over again why I don't like these types of businesses. What do I care about? I care about free cash flow. I want a company that's selling for a cheap valuation based on free cash flow. And dang it, if they don't produce just an explosive amount of free cash flow to be able to allocate wherever is most advantageous to them, that's what I like. This company does not produce free cash flow. So two of the five things you can do with your money, one is pay down debt, and the other is buy back shares. They're doing the opposite. They're not necessarily issuing that many shares because they're issuing it all in debt. And so, to me, it's I just don't understand it, and it to me feels like they're really ripping off their investors. If everyone else understands this, great. But to me, free cash flow is lifeblood of the business. If you don't produce it, you can't do anything with your excess cash. And so you have to issue debt or issue shares. And you can see they have issued debt. So much debt to fund everything. Their debt has gone from $1.7 billion to $3.9 billion over a 10-year period. And they have $4 million cash on hand. And they're not producing free cash flow. They actually have produced free cash flow one time, positive free cash flow twice in the last 10 years, once in 2017, once in 2013. And if there's any surprise or there shouldn't be any surprise, that was when interest was zero, essentially. Like they weren't paying anything on their debt. And so, of course, when that's happening, it's great and jolly to issue debt because that debt is free pretty much. Whoa, interest is 1%, 2%, that's jackably squat to them. And then it caught up. And then now if it jumps up a couple percentage points, that's going to really hinder them. And so, yeah, this will be, let's just get to some assumptions. It's just going to be, I can just throw these in pretty quickly. I don't really need to explain myself. I'm just doing averages here pretty much. And then the free cash flow, they don't produce it. So I just kind of finagled a Fugazi type number. And then they can't afford this dividend, but I still put something there. It's just not for me. This company doesn't produce positive free cash flow. I want gushing free cash flow. And when you have a gusher, bite into it just a little bit, and you don't eat it whole, which I definitely eat it whole, but you just bite a little bit into it, and that gushes out. I want that to be their free cash flow. We're not getting it here. So thanks. Chris, Jeff.